Good evening, ladies and gentlemen. Welcome to this, our post-MTBPS analysis. Our CEO, Andrew Moller, sent me a quote by US Senator Graham this afternoon, where the quote goes that balancing a budget is like going to heaven. The only problem is that nobody wants to do what it takes to get there. And that is so true. A budget is not an easy affair. And so we're going to have to dig thoroughly into it to get to the bottom of all the facts of it. The question I get most often is, so what's the difference between the MTBPS and the national budget? Well, the national budget is delivered in February and is essentially the spending plans and revenue collection measures for that specific year and how all the money is allocated to the different departments. Whereas the MTBPS, or as it's often called, the mini budget or the midterm budget, is exactly what that name says, the medium-term budget policy statement. And it's about the medium term, looking longer out, the assumptions that goes into that, and then the policy framework for next year's budget and for the medium term. And therein lies the importance of analyzing this budget, because it gives us a good sense of the authenticity, the honesty, the sincerity, the accuracy of National Treasury, or the minister, we use them interchangeably, about where they're thinking in the long term. And then we can interpose that, or the medium term rather, because it's like 3 years forward, and we interpose that over our own analysis of the global economy, and that gives us a good sense of whether this budget is a realistic expectation of the finances of the country, and hence the impact on the financial markets. Today, I'm joined by one of my colleagues, investment strategist and portfolio manager in the fixed income area, Vincent Masoloke. Vincent has 27 years of experience in the bond, FX, and derivative markets, so nobody better to assist me in looking into the detail of this MTBPS. And I'm immediately going to start with the important stuff. The assumptions that go in there. When you build the framework for a budget, the most important variable that goes in there is the expectation of GDP growth. Now, Vincent, what came out of today's budget in terms of the numbers for the medium term on the GDP numbers?
Good evening, George, and good evening to all your viewers. In today's medium-term budget policy statement, the GDP growth estimates were revised lower compared to where the numbers were drawn in the line in the sand in the 2023-2024 Fed budget. For instance, the estimate for the current financial year 2024 was set at 1.1%, and previously in the 2023-2024 budget, it was at 1.3%. So going out 3 years as well, the real GDP growth expectations were revised lower.
So that's an interesting balance, because on the one hand, we had these the positive sentiment going through the markets of late, and in some of the conferences that business had with government and the president, even a 3% GDP growth was mooted. Clearly, National Treasury did not get drawn in that. And in fact, as you said, the numbers placed into this medium-term budget were in fact lower than what we had in February. So a good dose of reality was imputed here. On the other hand, we have to also acknowledge that what is good to see is that the growth is increasing. It is from 1.1 to 1.7 to 1.9 over the next 3 years. And so it is an increasing profile, whereas if we look at the numbers for the US and for China and for several other countries, India, it's actually slowing down. So there is some positivity in there, but fact of the matter is these numbers were somewhat lower than expected. Vincent, what was the original market reaction when these numbers were published minutes past 2?
George, this has been one of the sharpest reactions we've seen during the during the medium-term budget speech in a long time. Both the rand and the bond sold off. So the rand was about more than 10 cents weaker since the beginning of the speech. And the local bond markets, the value of the curve, retraced by more than 10 basis points.
That's a big move during a budget speech, because usually budget speeches or the consensus is so well expected. So it just shows you that this dose of reality of lower GDP growth than what was expected was truly a surprise to the markets. I think a little bit of the GNU euphoria probably expunged from the markets right there and then at that point in time. But let's get into the nitty-gritty of this. Some comments around the revenue and expenditure numbers over the medium-term framework, Vincent?
About that. The budget deficit was revised to -5%, and it was basically initially expected to be at -4.5% for this current financial year. And if you look at the number from the current financial year out to 3 years, it is forecast to narrow to about -3% in the financial year of 2027-2028.
So once again, a bit of a yin-yang there, where the initial number now in this year is worse than expected. In the Fed budget, 4.5 and now 5% deficit. So it's worse. But then the number improves quite sharply to a number of 3.5, 3.2. What's that number in 3 years' time? So maybe a little bit of an optimistic, but then on the other hand, we'll get to it in a moment. There are some numbers which are front-loaded on the expenditure side, and maybe does show that that could be credible. So if anything, an improving growth profile, an improving deficit profile. So there's nothing negative in there, but also still the reality is a tough picture that leaves us in a deficit. Let's then talk a little bit further about that deficit, because that leads on to our debt to GDP ratio, Vincent, and that is such an important number for financial markets. Generally, it is considered that if an emerging country goes north of 80% debt to GDP number, then they are in a crisis. And then credit ratings goes to absolute junk. But where are we now on our debt to GDP ratio according to this budget?
According to this budget, the debt to GDP ratio was revised higher marginally for the year 2025-2026. The 2023-2024 budget had it at 75.3%, sorry, apologies, 73.5, and the current budget came out at 75.5 peak, and as well is expected to sort of to be constant over the years going forward. So 75.5, and then out to 3 years at 75%.
You sounded like Mr. Zuma there for a moment, but the 75.3 was revised higher. And typically over the last decade, we have seen that every single year, Treasury says that next year will be the worst year and then it'll get better. And then next year they say the year thereafter will be the worst year and it gets better. So, but we were higher before. That number was higher before. And so we have to remind people that the reason that this number dropped quite a bit, by a good 3 to 4%, was because of JAFECRA. Remember, that was our big thing of last year. The Global Foreign Exchange Contingency Reserve account, which was monetized in the previous budget, 150 billion rand extracted from that, and we saw a flow of 100 billion rand into the budget numbers for this year, and that assists in bringing that number down. But now we're creeping back up again. So if we can turn it around in the mid-75s, and it does start decreasing, as National Treasury now points out, then we could escape a downgrade. But what do you see in terms of downgrade or upgrade relative to that profile of debt to GDP number?
George, relative to that, the credit rating has not been changed, been maintained ever since the numbers have been published today. However, there's no likelihood of the fact that we'll be upgraded anytime soon because of this sort of worst number.
Yeah, I agree with you. And I think if you move around a bit for your light to come back on again, otherwise we'll only see your smile. I agree with you that the rating is unlikely to change with these numbers. They're not bad at all, but they're not good enough to
They're not good enough.
Upgrade. Yeah, so that's that one. Now, that also links on to our debt service costs. Where's our debt service cost now stand as a proportion of our total revenue?
Our debt service costs are 22% of revenue. And just to note, this is one of the fastest growing expenditure items in the budget.
The reality is that our total debt service cost, according to this budget for the next financial year, is 388 billion rand. So that means that government is spending more than 1 billion rand per calendar day just on servicing debt. So it is absolutely important that this is contained. Otherwise, we will have problems on our debt service costs and later on our ratings. Now, just to remind you, we are getting into the nub of the numbers here and why it's important. If you do have any questions, you're more than welcome to pop them into the Q&A box, and we are going to get to that a little bit later. We'll try and interweave it into the discussion. You are most welcome. This is unfortunately a bunch of technical stuff, but we want to get to the nitty-gritty of what the implications are for the investment market and for your investments going forward. Now, whilst we are talking about the debt service cost and the ratings, etc., and our growth is super important in this. Martin Ackerman, our chief economist, also highlighted in our post-budget discussion that National Treasury has scenarios in the back of the budget that takes those numbers that they've got there, that we have a 1.8% on average growth rate over the next 3 years, but they put it through two different scenarios, a bad case scenario, and they take growth down to 0.5% of GDP growth. Now, needless to say, then all the numbers are very bad. But it's interesting that their positive case, their best case scenario that they've got in that analysis is at a 2.5% growth for GDP in the medium-term framework. So that's interesting that this very positive speak we had recently is maybe a bit overzealous. That just shows that Treasury shows in the upside scenario where things really go well, that we only grow at 2.5. Now, linked to that, a different analysis shows that that debt to GDP number only starts reducing once GDP growth goes north of 2.5%. So the reality is that that number is going to remain under pressure. Limited JFECRA proceeds that can come into that number into the next years. And so that number will remain under some pressure. Now, Vincent, the next thing we look at is some of the big policy issues that exist in the country and how government allocates to those policies. That's exactly the type of stuff that we usually get in the MTBPS. But tell me what we saw on in this year's one about some of the big policy issues.
I fear that the budget was quiet on some of the big policy issues that will affect our debt to GDP going forward. I mean, there was a whole host of them. One of them in particular is the NHI and its ramifications. And the budget was silent as well on support on SOEs. We know that Denel remains a risk for the fiscus, and we know that Eskom remains highly dependent on government support, and the Land Bank has remained in default since April 2020. The Road Accident Fund as well is a significant fiscal risk. And as well, the budget was silent on the social relief of distress grant this time around.
So it's interesting that in the budget presentation, they list those things that you mentioned just now, the risks, but absolutely silent on any budgetary issues for them in the outer years. Now, do you think it's realistic that a budget will not contain any allocation to Eskom or to Transnet or to Denel or to Sanral or anybody post 2026?
This is highly unlikely, George, if you ask me. I don't think they'll afford to ignore this for a very long time, as this is pressing.
So they are kicking the can down the road. But the point is that the MTBPS also gives us confirmation that there's no further progression on things like NHI because there's absolutely no allocation and policy frameworks created for it yet. We need to touch on the FATF, the most famous, the Action Task Force grey list. We've now been on that grey list for a while, and National Treasury has worked hard to tick off some of the important measures that were placed there. In fact, at our latest feedback, they said that we have ticked off 16 of the 22 measures on that we would require to tick off before we could get off the grey list. The problem is that the remaining 6, Tennis Ehlers, our legal eagle and our tax expert explained to us this afternoon, those issues are out of Treasury's hands because this is all about relating to trusts and all around prosecutions that needs to take place, and they have to do that on a consistent basis. And the problem is the next assessment is in February, so it's highly unlikely we're going to get systematic prosecutions happening. Sustained is the word that they're looking for. Sustained prosecutions taking place between now and February, enough to impress them to take that off the list. So unfortunately, it's out of National Treasury's hands, which must be very frustrating for them. So it's going to be very difficult to pass that criteria list test in February, which means it takes us into October of next year. So it seems like another year worth of grey listing. And as Tennis highlights again, this just makes everything with dealing with foreign business so difficult for South African clients and investors. So unfortunately on that one, good progress made, but maybe a little bit longer. Vincent, the next thing I want to move to is inflation and inflation targeting, because there was some talk about that in the budget today. It was, as we know, that Reserve Bank Governor, Mr. Ganyagu, it seems like his pet project that he speaks about it regularly, that he feels that our inflation targets should be adjusted. Sometimes, you know, it feels like he's just over-optimistic and that the argument is if you aim lower, you'll get it lower. Well, he's probably right. But we looked at some global context about our peer groups. So give me a sense of our peer groups. Where are their inflation targets?
George, just to mention, our recent inflation print was at 3.8%. And coming to our peer groups, Brazil is sitting at 3%. Colombia is sitting at 3%. The Czech Republic is sitting at 2%. Hungary at 3%. Indonesia at 2.5%. Paraguay at 4%. Peru is sitting at 1 to 3%. The Philippines sitting at 3%. Poland, 2.5%. Republic of Korea, 2%. The Republic of Serbia is sitting at 3%. Romania is sitting at 2.5%. And Thailand is between 1 and 3%. Turkey, 5%. Norway, 2%. And the UK at 2%.
I like it that you got the UK in there. So we've turned them into emerging market as well, but it's good to have them there. And we never include Turkey because how can you show like an
obvious reasons, yes.
Turkey? But then again, Point is, Mr. Ganyagu has got a point there. I mean, our inflation, our latest print 3.8 with the midpoint of our target at 4.5. But there you had the numbers. Barring Turkey, ours is the highest of all of them. And our fundamentals don't deserve that. There's no reason for that to have structural inflation that's higher than all our peers. And so maybe he's got a point there. And there is a good chance that he does get his Christmas wish to get the inflation target down to, let's say, 3%. And then what would his thinking then be? Having a lower inflation target with currently a 3.8% inflation, which is below the midpoint. And then the Minister of Finance says, maybe we should reassess the measures of monetary policy. How does that take him into the next MPC meeting?
George, it's more likely that the governor of the Reserve Bank will cut rates in the upcoming MPC, given that. We can expect that. The next MPC is on the 21st of November, 2024.
So there you go. I think I've got a bit of a stronger view than you on that. I think the previous cut was 25 and maybe surprised the markets how hawkish that was. I think there's a good chance he cuts 50 at the next meeting, and that might just be a good injection for our economy to get things going. Let's get back to some of the budget issues. The other important thing that came out was that, SA's fixed investment, we aim for like a 2% GDP growth, but we only have a 15% fixed investment number. Whereas, our competitors, if you had to go through that exact same list of yours, but I'll just quote one of them, Vietnam, as an example, they've got 33% fixed investment spending, and then they got an 8% GDP growth, So when they talk about a infrastructure investment-led growth plan, because that's what National Treasury and the Minister is trying to get across, they call this a growth-enabling budget because they're trying to stimulate investment-led growth. But we truly need that because our fixed investment is the lowest of all those emerging markets that you just mentioned. And so our expectations to improve unemployment is unrealistic if we don't get the economy growing. And that's so important for our economy. The infrastructure is the big issue. We need to get public-private partnerships going on that. The National Treasury has been working hard with the World Bank and their multilateral investment guarantee agency to create a credit guarantee vehicle, and that'll enable private investment to flow towards infrastructure with that guarantee vehicle. We think that a lot of institutional investment money will flow towards those infrastructure projects, and that could really get the growth impetus going. In the February budget and in the State of the Nation address, both the Minister of Finance and the President said they want to fill the country with cranes and turn it into a construction site. Well, we need the money to get that going, and this is an important initiative to get that going indeed. So let's hope that gains some traction. So let's look at the first questions. The first question came in: what is your outlook for inflation in South Africa for 2025? Vinny, what's your thoughts around that?
My thoughts is that inflation has been rolling over, as we've seen from its peak in the previous 2 years. And it's expected to be at the midpoint going on to 2025, around 4.5%.
I agree. Yeah, I agree. The disinflationary factors have been positive for inflation, and so we are seeing a softening inflation profile. We do enter some base effects as we go into 2025, and so gains become a little tougher. Also, the geopolitical situation has been oil has been fortunate that despite all the geopolitics have actually gone lower, and that's probably because global growth expectations are cooling down. But if oil finds a bottom around 70 and gets back to 80, 85, that'll bring back some inflation pressure. Then I think, Vincent, you're right, that the downdraft in inflation will end and we'll get back to the midpoint, maybe 5% back. But there's no signs of runaway inflation into 2025 at this point in time. The financial markets have been much more cautious over the last 2 weeks, especially in the US, about the possible return of inflation as we get into the important event of next week. And while we're talking about it, let's go there. Vincent, what was the last that we saw on the expectations and the probabilities in the betting markets between Mr. Trump and Mrs. Harris?
I think Mr. Trump is still pitting Mrs. Harris in the probability markets. So Trump is expected to basically be the winner. It's a close call, though, George. I mean, if I have to recall the numbers from the top of my head, it was like, I would say 51-49.
Yeah, I would have said those betting markets were at 52-48, but I agree with you. It is very, very, very tight. So it'll depend on small nuances, how the swing states go, the size of the turnout. We've already seen a large proportion of people voting early, and generally those are the Trump supporters that vote early. So there's unique dynamics at play, but the betting markets are favoring Mr. Trump very slightly. I think because it's that close, it makes it pretty unlikely that we get either a red or a blue sweep. Do you agree with that, Vince?
I agree with that. I agree with that totally, George.
Now the US fixed income market, the bond yields have risen quite a bit because both these candidates have indicated that they'll probably spend quite a bit of fiscal impetus into the economy. And that has brought back some fears of funding and inflation, and hence why we've seen a backup in US 10-year yields from 360 to 430. But if it's this close, then more than likely we're going to find a split house in Congress. And that is generally seen as good by the markets because that imposes some discipline into the US process. So if anything, a divided House and Congress, and we could probably see those yields coming back lower. And it seems like both these candidates with their fiscal spending plans, it'll probably be supportive of US equity markets. Speaking of US equity markets, some of the first results have been coming out, and it's been close to expectations that this quarter earnings somewhat slower than before. We're now in the bottom half of tens in terms of earnings growth. So the original expectation was for 4% for the quarter. Market will probably beat that, so we'll get to 5 or 6%. But this seems to be the lowest quarter. From here on, earnings growth expected to go a good double digits again into 2025, which is very strong, backed by the fiscal policy of either of the two candidates. And so quite a rosy picture at this point in time, but we have to get through the volatility of the election, because as we know that there are fears that if Mr. Trump does get elected, he wants to impose tariffs, and those tariff wars are very dangerous and uncertain for financial markets. Europe has already placed their tariffs on Chinese EVs, and that has caused a lot of volatility and uncertainty in that space already. So get Mr. Trump added to that, we could have quite a bit of volatility during this end of year period thanks to the elections. Now, Vincent, the other thing I wanted to highlight is that we literally come into this MTBPS of ours, and we've had a lot of positive things for and in South Africa happening. I mean, post the election and then the formation of the GNU, and literally since that formation of the GNU, you know, that was backed by the fact that we had no more blackouts, that global interest rates started being reduced, business sentiment, consumer sentiment improved dramatically, global investor sentiment towards South Africa improved because the risk premium of the uncertain scenarios that we had got expunged from our assets. And so bond markets rallied hard, so did the rand, that strengthened, and the equity market followed all of that. So a very, very positive environment and expectation and sentiment as we get into this MTBPS. And then suddenly, you know, this MTBPS growth gets marked lower and shown lower than where it was before. The deficit is higher. The peak debt to GDP number is higher than before, and the tax revenue shortfall is higher than before. So it was a kind of a rude awakening, this MTBPS, to this very positive sentiment that we've had. Do you think that this MTBPS turns that positive sentiment around at all, or is this just a reality check?
George, I believe this is a reality check. To be honest, I don't think there's anything negative out of the policy statement. It's clear that.
It's clear that.
No, I'm saying it's clear that the SA fiscal issues are influenced by international factors.
Yeah, it was good to see that. Now, it was interesting that they acknowledged again in this budget, and in fact in their summary presentation they've got it very clearly set out, that they base the budget on 4 pillars: maintaining a macroeconomic stability, implementing structural reforms, building state capability, and supporting growth enhancing public infrastructure investment. And that was absolutely wonderful to see. Also, Project Vulindlela is the base of those structural reforms that they want. Project Vulindlela was all about water and electricity and transport and telecommunications and visa reforms. Now they've added even 3 more of those, 3 more to that. So it just shows that that project really has gravitas, and the presidency has got a control over it. And the presentations we've seen out of Project Vulindlela has been so positive. The people working on it are so informed and competent and understand the dynamics around it. We literally need that to get into the economy, and the private sector can join the party, and then these growth numbers will probably end up being the low point of this cycle. So there truly is a lot of positivity and positive things out there and from the budget. Let's see if there's any further questions in the Q&A box. I don't see anything there right now. Any other comments, Vincent?
Just maybe to close off, to tie the loop. The markets have actually moved back to where they were before the announcement of the medium-term budget policy statement. So from that knee-jerk reaction, we're seeing the market has sort of come down again.
Well, that's great to hear. That just shows the confidence that the markets and the investor community has in National Treasury and the minister. This budget was a cold shower shock of reality to the overzealous positive sentiment that existed maybe for it. But that confidence it's wonderful to see that the market has that in Treasury, and so that can take us into higher ground. In terms of market expectations, this just shows that nothing is broken, that the positive spell that South Africa has gone into over the last while maybe has more legs. We have some volatility to get through from the global aspects that have to come through, the elections, the geopolitics in the Middle East, major issues. We have to get through an important period that shows that the US economy is slowing down somewhat, and just to see that doesn't end up in a hard landing. But for now, it looks like the US Fed has got it totally under control, and that they are engineering a soft landing, which would be a fantastic outcome for South Africa. A more important thing for South Africa in the short term is Chinese stimulus measures. The economy has been cooling down, and they have started applying some stimulus to that economy. It's been light relative to what they've done in the past, but they could probably bring out a lot more. In fact, their next meeting is on the 8th of November. That'll be very important policy announcements for the Chinese economy, with knock-on effects onto commodities and onto South Africa. So some volatility ahead, but it seems like this budget sets a very honest and transparent platform for this environment that we are in, and it doesn't seem like there's anything broken. If anything, it does look that the growth trajectory can improve somewhat. Vincent, thank you very much for joining me on this webinar. It's always important to analyze the budget sharp and thoroughly directly afterwards. And we did that today. We'll do the exact same thing in February again, come the national budget. I see here at this late stage, a question came in, no allocation for NHI. Nope, no allocation for NHI. Not a word of NHI spoken in the medium-term budget. So yeah, that was one of the policies we were looking for guidance on, and there was nothing there. So yep, we'll do this again. As always, at Citadel, we plan for many scenarios around our investment process. Our investment advisors make sure that your investment plan covers all of those scenarios, and we are truly committed to managing your long-term wealth. And it's been our pleasure and our privilege to spend this quick 40 minutes with you post the medium-term budget policy statement in South Africa. Thank you very much. Goodbye.